Currently trading around 1.38 per share, Tilray Brands, Nasdaq TLRY, has seen a staggering amount of volatility, with its 52-week range stretching from a low of 0.35 to a high of 1.88. This dramatic swing is more than just a data point. It's a stark reflection of the deep-seated tensions at the very core of the cannabis industry, a story of grand promises and stubborn, often brutal, realities. The common narrative is that Tilray is a pure-play bet on federal legalization in the U.S., a stock that will finally break out of its multi-year slump when cannabis is descheduled. But what if that narrative, while true on a surface level, completely misses the deeper, more immediate factors already at play? What if the most powerful catalyst for this stock aren't about a future regulatory change, but about a far more complex and already unfolding strategic pivot? The expectation is that Tilray's future hinges entirely on a single binary event: U.S. federal rescheduling. It's the pot stock equivalent of waiting for a lottery ticket to be drawn. Investors, particularly the retail crowd, are fixated on headlines and political rhetoric from Washington, D.C. And for good reason. Such a change could unlock a massive market. But the reality is that Tilray's leadership, under CEO Irwin Simon, has been diligently, and perhaps shrewdly, building a completely different kind of company. They've been de-risking the business by aggressively diversifying away from a sole reliance on cannabis and into more stable, traditional consumer packaged goods, CPG markets. This is the crucial, often overlooked part of the story. While everyone is waiting for a political savior, Tilray is building a multi-billion-dollar beverage and wellness company with a cannabis-infused back end. This strategic shift is not just a side project. It's the very foundation of their long-term survival and, ultimately, their potential for meaningful profitability. The question is no longer, will they make it when legalization happens? But rather, what kind of company will they be when it does? And how much value are they creating in the meantime? To truly understand Tilray, you have to look beyond the cannabis-centric lens and examine its multifaceted business model. The company operates across 4 distinct and interconnected segments: cannabis, distribution, beverage alcohol, and wellness. The cannabis segment, while the most discussed, has been a story of strategic consolidation and international expansion. The 2020 merger with Aphria was a landmark event, creating a global cannabis powerhouse with significant market share in Canada and a formidable presence in the burgeoning European medical cannabis market. This European focus is a key differentiator. While U.S. legalization remains a long shot, markets like Germany and Italy are steadily and predictably liberalizing their medical cannabis laws. Tilray's partnership with Italy's Molteni, for example, is not a splashy headline, but it's a concrete, low-risk move that expands their footprint in a stable, regulated environment. This is the antithesis of the speculative, all-or-nothing U.S. market. It's a slow burn, but it builds tangible recurring revenue streams and allows the company to develop a global supply chain and distribution network that will be invaluable in a post-prohibition world. They are building the infrastructure for a future that is already here, not just one that might arrive someday. The second and perhaps most underappreciated part of the Tilray story is its aggressive pivot into beverage alcohol. The acquisition of 8 beverage brands from Anheuser-Busch last year, including household names like Breckenridge Brewery and Blue Point Brewing, was a masterful strategic move that few saw coming. On the surface, it seems like a desperate attempt to find a new revenue stream, but the application is far more profound. This wasn't just about buying beer brands. It was about acquiring a proven, sophisticated, and legal nationwide distribution network. In the U.S., cannabis companies are trapped by a patchwork of state-by-state regulations, unable to cross state lines. But with their newly acquired beer and spirits portfolio, Tilray has a fully operational, federally compliant CPG distribution system. This dual-purpose infrastructure is a massive competitive advantage. It allows them to distribute their non-THC products today while building the skeleton for a future in which they can seamlessly integrate cannabis-infused beverages and other products into a legal national market. This is the kind of forward-thinking, long-term planning that the market often fails to reward in the short term, but which creates immense value. While competitors are still stuck in the regulatory mud, Tilray is already building the highways. The financial reality reflects this tension between a long-term strategy and a volatile market. Tilray's revenue has been growing, with a notable surge in the beverage alcohol segment. However, the company remains unprofitable, and its stock has been plagued by a low share price, even necessitating an extension from Nasdaq to meet its minimum bid price requirement. The market sees the red on the bottom line and the risk of delisting and becomes bearish. But a deeper look reveals that much of this unprofitability is a direct consequence of a strategic spending spree on mergers and acquisitions, a necessary evil to create the diversified global footprint they are building. The company's balance sheet shows that their current assets exceed their short-term obligations, a sign of robust liquidity that provides a critical buffer during this high-growth, high-expenditure phase. The negative EPS and profit margin, while concerning to a casual observer, are a predictable outcome of a company investing heavily in its future. This is a crucial framing point. Is this a company that is simply losing money? Or is it a company that is strategically spending money to acquire market share, intellectual property, and critical infrastructure? The data suggests the latter. This is where the contrarian take becomes a matter of intellectual honesty. The common belief is that Tilray is just another struggling cannabis company, a relic of the green rush bubble. But the reality is that it is a company with a strong leadership team, a clear, long-term strategy, and the financial wherewithal to execute it. The merger with Hexo, for instance, consolidated their position in the Canadian market, creating efficiencies and reducing competition in a mature market. This isn't sexy, but it's smart business. They are playing a long game of chess while everyone else is playing checkers. They are building a moat, brick by brick, across multiple geographies and product categories. The challenge is that the market demands instant gratification, and Tilray's strategy is inherently one that requires patience. The stock's dramatic volatility is a testament to this, swinging wildly on a whisper of a political change or a minor analyst upgrade. But the most powerful and often unstated insight lies in the psychological and strategic impact of their diversification. By building a robust, profitable, and legal beverage and wellness business, Tilray is subtly changing its own risk profile. When and if U.S. legalization happens, they won't be a fragile cannabis startup looking to capitalize on a single opportunity. They will be a massive, diversified CPG giant with a legal cannabis division. This distinction is critical. They will have a stable, non-cannabis revenue base to absorb the inevitable shocks and growing pains of a new market. They will have existing brand recognition, a loyal customer base, and a battle-tested distribution network. This de-risking strategy means that the company's valuation should not be a pure function of the volatile cannabis sector, but rather a hybrid of the cannabis and CPG industries. This is a completely different way to frame the investment, and it's one that has not been fully priced into the stock. The competition adds another layer to this narrative. Tilray is up against rivals like Canopy Growth and Kronos Group, but it's also now competing with mainstream beverage companies. Its aggressive M&A strategy, particularly in the beverage sector, has set it apart. While Canopy and Kronos are still largely pure-play cannabis companies, Tilray has created a new category for itself, a cannabis lifestyle brand. This isn't just marketing jargon. It's a fundamental shift in business model. They are positioning themselves not just as a provider of a controlled substance, but as a holistic wellness and leisure company. The wellness segment, including hemp foods and other natural products, reinforces this broader vision. The company's goal is to become a dominant force in the broader CPG landscape, with cannabis being a key, but not the only, driver of growth. In summary, the narrative surrounding Tilray Brands is often overly simplistic and fixated on a single external catalyst, U.S. legalization. But the deeper, more compelling reality is that Tilray's leadership is not waiting for a political miracle. They are actively and aggressively building a diversified, global company with a clear and intelligent strategy to de-risk its business and create multiple paths to profitability. The company's strategic pivot into beverage alcohol and its sustained focus on the stable, growing European medical cannabis market are not minor developments. They are the central pillars of its long-term strategy. This is a story of a company consciously shedding its identity as a speculative pot stock and evolving into a diversified CPG powerhouse. The market's fixation on short-term volatility and red ink misses the profound strategic moves that are quietly creating a foundation of immense, sustainable value. Tilray is not a bet on a headline. It's a bet on a meticulously executed business plan that will be re-blank